Hi, everyone. This is Jason Bierko of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We're recording this interview on Tuesday, September 23rd, 2025. The US dollar gold price is just under $3,800. The silver price in US dollars is around $44. We've had a huge rally the last 6 to 7 months. Today's special guest is a registered investment advisor. He also has a gold and silver hedge fund, and he stores physical precious metals in a safe, secured vault for Idaho Armored Vaults. Bob Coleman, thank you for joining me again.
Hey Jason, how you doing?
So, Bob, I want to ask you about supply and demand right now for gold. One of my other contacts, James Anderson, who is a sales director at Gold and Silver, goldsilver.com with Mike Maloney. I think he's with SD Bullion, and he covers a lot of the gold and silver market news. He shared like a screenshot showing that there was a ton of retail investors, I think, here in the United States and Canada that were just sending their metal, I guess, out of necessity, maybe because the economy is not doing well, to the refiners to melt down into into other products. Are we seeing that right now where the retail investors, a lot of retail investors in the US and Canada are not large buyers of gold and silver and the demand is coming from somewhere else?
Yeah, I think you can make a very strong argument that the number of tickets being written are down, but the size of the ticket may be a little bit higher, and that's mainly due to a lot of people taking money out of the stocks and crypto and so forth, going into the metals markets. With the price of going up in gold and silver, that tends to attract an audience and momentum money, and then that kind of spurs more price action. So you get this capital flow that comes into the sector, and I think you're seeing at the same time higher net worth individuals that have made a good amount of money in the stock market are saying, "Hey, listen, the political uncertainty, the wars going on, the all the rhetoric, the trade potential problems that we're seeing, all the employment statistics, as well as some of the economic index or economic measures and so forth, all showing some potential weakness developing. I think that's just making people say, listen, maybe the best place to put some money is in the metals, and I know it's not going to go to zero. And at the same time, if the dollar devalues or continues to go lower, at least then I have some sort of hedge. And I think that's what you're kind of seeing right now. It's also interesting that India continues to be a big buyer in the metals. In fact, there was a gold conference over in New Delhi, I think a couple weeks ago, and one of the managing directors for, I think it was CGR Metalloys, was talking about how they're seeing a very difficult flow of scrap metal coming back to the refiners. That's typically a good source of secondary supply, and they're not seeing it. People are not letting go of their metal, either whether they're concerned about missing out on higher prices, or just maybe the political environment is such that that it makes them want to hold on to the metal from a store of value perspective. But I thought that was an interesting thing to kind of see. Was even refiners over in India just aren't seeing people letting go of that metal.
And we just got some new data from Kitco and Reuters. They're saying that Swiss gold exports to the US are down after the tariffs, but they're up enormously to China, 353%, so almost 400% increase of Swiss gold refiner exports to China. So, I mean, the demand is coming from somewhere for this huge increase in the price with gold and silver. But from what I've heard from my sources and the bullion dealers, a lot of retail investors were not buyers of gold and silver. A lot of people are actually, like, because of the state of the economy, Bob, and we were talking before we started recording about inflation, stagflation, a recession in the United States, people that are losing their six-figure jobs from artificial intelligence software. The tech companies or the large S&P 500 companies are doing mass firing. They're not hiring recent college graduates to the high-paying jobs that the college graduates expected. So these are all instances here where the party, if they had the higher income, the discretionary income, the savings, they could go and maybe dollar cost average and go buy gold and silver. But I think the gold and silver demand, Bob, would you say that the majority of the demand, is it coming from like foreign central banks? Is it coming from institutional investors or pension funds? Where is the demand coming from?
Yeah, you brought up a good point. What you're tending to see right now is a lot of institutional investors coming into the space, or high net worth investors, or just general investors that don't necessarily invest in the physical metal, but they rather go into the ETF world. And what you saw last week, there was a 1 day where gold, about 861,000 ounces of gold came into the gold ETFs, which was actually the most that we've seen in 3 years, a 1 day event. So certainly seeing that type of, I think it was like $3 billion coming into the gold space through the ETFs. So that's actually been kind of spurring some of this activity, and that could be momentum money, it could be fast trading, it could be options related with option expiration last week. Who knows? But it's you certainly seeing the money flow on the institutional side really driving the market right now.
Do you think then that so they're not going to be going to companies like yours and asking for secured storage of the physical metal? You think then that they're perfectly happy then with GLD and SLV, and they're not questioning whether or not there is actually physical metal like counterparty risk or anything like that? They're not asking those questions yet.
Yeah, I think most of these institutional investors aren't the typical it may be funds that are more keen to counterparty and systemic risk. They're more, their charter says that they have to invest only in funds or securities. They can't really get involved into physical assets, especially if you go into in Europe, where Europe frowns upon investing directly into physical assets. They actually promote UCITS, which is derivatives or funds that go into that are derivative backed, where you can't actually take a physical product you can't actually
So they're all about what paper ETFs or other.
correct. Yeah.
Ugh.
Yes. Yeah, yeah. So it's just the same old, where, and this is something I've tried to explain and educate people on the difference between ETF flows and how that influences the price. Versus if you had that same amount of money going into direct physical metal, I think you'd see a different story with maybe even a tighter market, especially on the lease rate side, so forth. If it goes into ETFs, it's more sort of like that money's being corralled and controlled, I think, a little bit better in the banking system.
I was actually next, my question, I was going to ask you about the LBMA and the spike in silver lease rates because you were talking about that over the last couple of weeks. There was a huge spike in the cost for leasing silver on the LBMA. Could you maybe talk about what, for our listeners out there who aren't familiar with any of this stuff at all, what a lease rate is, why an entity would actually do that and go and lease silver?
Yeah, it's fairly common. Like for fabricators, for example, instead of buying the silver and then melting it down, fabricating it into its end use product, and then maybe a month or two later selling that product. Think of it as like the U.S. Mint, for example. That'd be a great example. They will go and buy a metal, whether it's silver or gold, make the product, and then a month or two later, that product is finished, and then they to bring it to market. The problem is they don't know where that price is going to be between where they buy it initially and then when they sell the end user product. So a lot of companies will come in, and in order to get metal, they lease that metal from a bank, meaning they don't really take the price exposure, because what they're doing is they'll use that metal, make the product, and they pay a financing cost to basically use that metal. And then when that metal is made in its 1 ounce form or whatever fabricate and use fabrication form, then they sell the product. When they sell that product, that's when they actually buy from the bullion bank the net ounces. So what they do is they pay this sort of financing cost by the between the time they
Are the
actually.
end users, they're not buying like silver coins or bars then? They're using the silver then for like solar panels or electronics then?
Possibly, or but a lot of times they're just reselling that product, um, to like you said, end users. So it could be industrial, it could be investment purposes. But at the end of the day, the lease is really more of a way to hedge their fabrication program without taking the cost of buying the product outright, waiting 3 months to make it, and then selling it. Here, the lease is a little bit cheaper to deal with, and the bank then what they do is they take the risk of where the price will be when the lease is up and when the client actually ends up buying the metal uh, from the bank, and then and the bank closing out that lease. It's a little bit convoluted, but it's just the way how it's almost like a furniture company selling somebody furniture on credit, and then all of a sudden 3 months later, that person may not be able to afford that furniture all up front, so they finance that. It's kind of a similar type of arrangement.
Now, with the increase in the silver lease cost, does that mean that there's a lack of supply on the LBMA? So the end users who need the silver for whatever purposes, there's a lack of metal. Why do you think there's an increase in the cost for leasing?
Yeah, that's typically what happens. The market gets tighter. So it's just like with interest rates. When the cost of money starts to rise, that means there's less money available. Well, in the physical metals world, think of it as the same way. When there's less metal available, those lease rates start to rise. And that by increase in lease rates, you're maybe drawing out someone that has a stockpile of metal that they're willing to actually lease that out if they can get a higher rate for it. So it's very similar to someone that's looking for a loan. Someone that's willing to pay a higher interest rate may get somebody off the couch willing to part with their money for that higher interest rate. So leasing is very very similar in nature. And what happens is, if you look at London, for example, that float that where the total amount of silver that's on the LBMA or that's in the vault data. A majority of that is ETF and spoken for metal already. So as more metal goes into the ETFs, that pool of available vault metal within the LBMA system shrinks because more of it's going toward those ETFs as ETFs attract more money. So that tightens up the available supply, and then all of a sudden lease rates rise, and then you have this crossover effect that when lease rates go up for actual physical metal, then what happens is the equity participants get involved and say, listen, if it's too expensive to deal with the physical, well, let's just go into and replicate that with the derivatives or for example, SLV. And so equity market makers this last year got involved more and more into the metals business via stock loan of shares and so forth, making money on loaning the stock shares out as a
You mean
proxy.
borrowing like shares of SLV for short sellers or something?
Yeah, lending and borrowing. Yeah, that type of practice where they're making money on lending those shares out, and then people that are shorting, for example, using SLV as a short leg, for example, on maybe having an underlying position, but looking for the hedging, going to, for example, SLV and using that as a the short side of their leg. But it's a practice that a lot of people may not understand how the financial side of the metals business works, and that's one of the reasons why you watch the exchange for physical spreads. That's the spread that's between the London spot price and the New York futures price, and so you have a that spread of because with the futures price that kind of takes into account the time value of money. So the futures price typically is higher than the actual spot price, and they call that contango. But what happens is the banks and a lot of participants will short the futures and go long the physical, and they lock in that arbitrage spread. But what's happened this year with the tariffs and sort of the tightness in the market and the exchange for physical spreads have been blowing out as well. So you've had participants that are short the spread, and all of a sudden the spread goes from like plus 30 cents on silver to plus 75 cents on silver an ounce. It doesn't sound like a lot, but when you times that by tens of millions of ounces, it becomes a very quick and deep loss on the
Especially
books.
especially if you have like leveraged positions, like you've used debt to buy your options, to buy your futures contracts, or you're using options on futures. You start doing leverage upon leverage, and then it starts to get messy with that increase, like you said, because it's multiplied over a lot of contracts.
Right. Yeah, and all these types of traditional measures of formulas and trades that are done for hedging practices and so forth, all getting blown out. It's creating a problematic event for balance sheets and income statements because you're having to mark to market losses because one month, Trump talks about tariffs and all of a sudden the EFPs blow out, which traditionally they don't blow out. And these players have to have really deep pockets when you're short the EFP.
Well,
Um,
also the silver price on the supply side, Bob, hardly moved at all. It was stuck in a range over the last up until the last 6 to 8 months, but it had been stuck in a trading range for years. So there was almost no incentive for a lot of these base metal miners or gold miners with silver byproduct to bring on new supply, and their input costs were rising. But now, like over the last, I would say like 12 months or so, you finally got really good profit margins and free cash flow with the low energy prices on the supply side. So maybe now there's more incentive to start bring on supply, but there was no incentive for years to bring on new supply.
Yeah, and that brings up an interesting point with what you just said about the miners and low energy costs and so forth. So now you have profit margins at all time highs, really almost surpassing the highs back in 2011 when gold peaked back then. You're at near or above those profit margins. So now, if you're invested in the mining stocks, you have to worry. Okay, if we start to see inflation rise across the board and energy prices start to go up and input costs for miners start to rise, because you're right, they've been in a perfect world right now with low energy prices, but if now all of a sudden energy prices go up, a lot of the low lying fruit has been picked. You're going to start to see profit margins start to get impacted, even as maybe metal prices continue to go higher.
Actually, I would argue the profit margins are the highest, if not tied for the highest ever. Because I think I saw a chart that back in the 70s, the profit margins were around these levels for the gold miners. We have gross profit margins. The industry average is around 50%, maybe a little bit above 50% gross profit margin. So that's like insanely high. Really good, robust free cash flow. Although, like the next new line of supply, I think is going to be much, much higher cost mines compared to the past. So the current mines that are in production are low cost compared to the future supply. But the other side of this, Bob, is that the actual demand for metal, there's been huge increases over the last couple of years for China and India for industrial demand for solar panels and electronics, right? So like China and India are installing a lot of silver into solar panels and other industrial uses.
Yeah, definitely. And not only that, you have just from investment demand, you had a little bit, as China's stock market has started to rise. July actually saw a big outflow of gold out of their ETFs over there, and that money transferred over into their stock market. So as stock markets continue to rally, for example, that could start to draw people back out of gold. As they get more confident, and again, some of the outflow that you see, some of it may flow have been coming into the metals from crypto, and the same people will be like, well, I'll sell my gold now and go into crypto and see if I can make my windfall there. So the markets are full of just constant flow of money. It's almost like water moving in the bathtub.
I want to ask you now about like the overall strategy for government, central banks, non G7, the BRICs countries, because it really seems like there's been a paradigm shift the last like 3+ years, 3.5 years after the Russia sanctions. I was reading comments from a central banker in Poland. It was in a Kitco central banker survey recently, and it basically sounded like the guy was reading Austrian School Economics, talking about we own too many U.S. Treasury bonds. We need to start hedging with gold. We need to add more gold. We need to add other reserve assets Do you think like the US has pulled like a Yosemite, like whether they're Republican or Democrat in the White House or Congress, do you think that all the policies they pulled a Yosemite Sam, shot themselves in the foot, and finally like the BRICS and the non-G7 countries like have said enough, we're not going to be buying more treasury bonds and we're just going to start stockpiling gold?
Yeah, I think you've seen that in the data, where even the tick data, even though the tick data shows foreign ownership of treasuries rising, that actually may be data that's actually with the dollar going down, that actually has aided the tick data, not so it provided it. I think it distorted actually the realization that foreigners of treasuries may not be owning more. In fact, actually, if you look at central banks holding U.S. Treasuries, or foreign central banks holding U.S. Treasuries for accounts, that's actually been declining big time over the last year. So you've seen you've seen that, but interesting enough, it's funny that you mentioned gold and how people are looking at gold as sort of the hedge for maybe their balance sheet or for bond positions, whatever it may be. You look at Cantor Fitzgerald. Cantor Fitzgerald, for those who don't know, it's a big primary dealer, Wall Street brokerage. Was run by Howard Lutnick, who's the Commerce Secretary. They just came out with a product. It's a Bitcoin gold fund, and their marketing is such that says, "Listen, we're gonna invest in Bitcoin with all its advantages, and it's great returns and so forth. But we're also investing in gold. So if Bitcoin does go down, gold will probably go up as a hedge against the downside on Bitcoin." It
Didn't
was
Tether announce that they're starting to buy like gold company shares? I think they're announcing that they were buying
yes.
Amex Royalty and other gold company shares. So I mean like these stable coins and some of the stuff they're buying is gold related, either gold stocks or actual like gold exposure.
Yeah, and you have to be as a mining company or mining investor, you have to be a little bit nervous of, you know, mining companies are a great trade, in my opinion. Whereas the metals, the actual physical metals, is really more of a store of value. Because, like you said, if you get a change in profit margins, which people may not be aware of, and all of a sudden input costs start rising at a faster rate than the underlying price of the metal if they're mining is going up, you actually will have a net drawdown in profit margins, and that'll you'll probably see that in a reduction of stock price, even though people are saying, well, God, the price is going up on the metal. Why isn't the stock going up? So you want to be careful of that because they've had a big run this year.
Oh yeah, that profit margin differential problem that you're talking about, that's actually what happened in 2011 at the last
Mhm.
top there, because at one point the mining costs were rising faster than the metals prices, as my friend Rick Roll likes to say about that, because all the input costs were just going absolutely bonkers back then. But right now, I mean, we're in a sweet spot. The gold mining industry has the highest percentage of increase, I think, in free cash flow growth over the last 12 to 18 months of any industry.
Yeah, that's amazing. Yeah, so yeah, it's one of those things you just, as an investor, probably your listeners are well aware of because of your experience with this. But for a lot of people out there that are jumping into this asset class, they're not aware of all the sort of the volatility and pricing mechanisms that uh, portfolio managers and traders watch for.
Well, I want to ask you more about like the BRIC strategy, the comments, because Trump is doing press conferences. I mean, I just saw him a couple hours ago here on Tuesday, September 23rd, 2025. And I mean, he mentioned again increasing sanctions on Russia and Putin. So he was like, maybe our sanctions weren't high enough. We want to get that. We want to do this. So do you think then that this talk, if they actually do the sanctions or not, I mean, it's just going to convince what the China, Russia, the other BRICS countries, non G7, that why are we buying so many US treasury bonds? Do you think then that they're going to see like all this rhetoric and the budget deficits or the size of the budget deficits, even with the Trump tax cuts, the national debt, the U.S. national debt it's growing like way faster now than $1 trillion of debt added in 100 days. I think it's down to almost under 80 days now. So do you think they're going to look at like all these different things from a supply and demand standpoint, the potential for more sanctions, just say, you know what, this is just a headache, this is a migraine, we're done with treasuries, we're not going to be adding anymore?
Yeah, I mean that's been the concern I think central banks have looked at, is the sort of lack of participation, lack of trust. The idea that you have an administration that could become, if you're a foreign country, could become hostile if all of a sudden, your natural trading partner, which may be at odds with the U.S. interests, you're stuck now in the middle between a trade war, and then you're a casualty of that. So I think there's that recognition that these countries are saying, "Hey, listen, instead of getting involved in something that could really backfire on us, and then all of a sudden we're kind of beholden to, some other country's best interests, we have to look out for ourselves." And I think that's been sort of the over the last 15 years, it's been recognized that you've had this big push from central banks and foreign governments, to invest more into gold as a neutral reserve asset.
Well, or you have $300 billion, which is what Russia had, and their interest payments on that 300 billion of U.S. Treasury reserve assets, and it's just frozen or confiscated because I think the interest payments were also confiscated as well. So if you see that and you're another country and you're worried that the U.S. is threatening sanctions against you, I mean, why not just start dollar cost averaging gold tonnage and have the gold like with your military or other entities ship back to your own country and store it yourself then, rather than risking, your tens of billions or hundreds of billions of dollars worth of reserve assets being confiscated or stolen.
Yeah, especially when you're living in a world of finances where collateralization has become almost the and it's almost the tip of the spear, when it comes to managing money. And if you have an asset that can be collateralized, that's just that much more power for that central bank to be able to expand or use that leverage.
I want to ask you about some of the old books that Jim Rickards wrote. So he wrote Currency Wars, which was, I think, 2010 or 11. And then he also wrote The New Case for Gold. Do you see things playing out like that, where like the US basically, he did a financial war game scenario in Currency Wars. And I recommend all my listeners that listen to this podcast go and buy the book or the audiobook and listen to it if they haven't yet. Also, The New Case for Gold. And basically, he said at some point the US would run out of options. The US would potentially want to devalue the dollar against gold, to start inflating away the debt or financial repression and yield curve control. But then he also said that China and Russia wouldn't like any of this stuff and the sanctions, and they would start setting up like an alternative financial system with some type of gold. So they would start, because in the financial war game scenario, basically a lot of the stuff that was discussed back in 2010-11 in that book, it's playing out right now.
Yeah, I think the scary part for me as an investment advisor is this radical push for digital assets to become, almost our reserve asset, to try to show the world, hey, listen, we're going to lead the charge on digitization and Bitcoin and so forth, and that's where we see value, because I think the U.S. realizes the rest of the world also has a lot of gold, and that we cannot use gold solely to reflate with, because it's going to reflate the entire world at the same time. So our idea is, well, if we have this digital asset that we can control, all of a sudden maybe we can extend and pretend, our power, so to speak.
Well, I think Bitcoin and stablecoin, Bob, are being used for other reasons. So I think like they realize some of the huge problems with treasury market, the lack of demand from the usual buyers like Japan and China and some of the other BRICs and G7 non-G7 countries that used to buy these treasuries when they were running trade surpluses in the past. And I think you've heard the comments. You mentioned Howard Lutnick, right? He's the Secretary of Commerce, but you've heard the
Mhm.
Treasury Secretary Scott Bessent. Trump has even talked about this. His other advisors, they've talked about that they think the demand for what Tether and stablecoin for treasury demand, it could go up to $3 trillion soon.
Yeah, I think that's a very high number. I think a lot of people tend to think maybe 600 billion is it would be, even if they get to that, it'd be incredible. But the stable coin scenario is, it's not for the U.S. investor. This is designed for the retail foreigner that says, listen, maybe my currency in my country is, not worth the paper it's written on, and I'm looking for a store of value. So therefore, I go into this stable coin that's backed by the U.S. dollar. But in reality, that stablecoin does not pay any interest. So think of it if, and for listeners in the U.S. where they're invested in money market funds where they get paid, 3 or 4% invested in treasuries. When you're in a stablecoin that's backed by treasuries, the fund itself does not pay anything to the user.
Well, I think like the stablecoin, they're promoting this because number one, they want the Bitcoin price higher, but also with the stablecoin demand increasing, that means the stablecoin can go and buy more US Treasury. So I think that's the goal.
Mhm.
They're trying to plug the hole here in the supply demand problems in the Treasury market. And they think that what a higher Bitcoin price, more stablecoin demand means that the stablecoins will be able to buy more US Treasuries. I mean, even Eric Trump, I think, is involved. I think he just launched a new stablecoin company and it's already got a valuation over $1 billion. He was just on Fox Business last month promoting it.
Yeah, and you would think from a political standpoint, we vote people in to serve the public's interest, but
That's not
it's
what happens.
I
That's not what
know.
happens with either political party. I mean, I've met champagne socialist hypocrites here that'll go on TV bashing capitalism, but like, when the TV cameras are not recording, all they talk about is the most expensive things in life. I mean, like these people are all about like their stock trades and real estate
Hmm.
deals and
Yeah.
private jet rides and super expensive. And these are people like going on TV talking about how much they hate capitalism and billionaires and how good socialism is. I mean, these people are the worst, most corrupt hypocrites imaginable.
Yeah, and I think a lot of the precious metals crowd tends to kind of see that and says, listen, that spells corruption in a way, from a simplistic standpoint. And so, you buy metals for the idea that, hey, listen, if this thing is all built on trust and confidence, and we see the politicians, which are supposed to be serving the public, serving themselves, how much longer will that last, and what will that do to the confidence of the system?
Well, they kept the system going with a lot of the other empires like the Roman Empire and the British Empire. A lot of those, they kept those system going with currency debasement a lot longer than people thought. So, I mean,
Hmm.
they've look at the dollar has been debased massively for decades now, and just in what the last couple of years, they increased the money supply even more than that and devalued the dollar again.
Yeah, but it's a scary thing because once trust is lost, and then all of a sudden, these things start to slip. They can slip very quickly, out of control, and I think that's the hard part. We're all trying to figure out, how high can you climb on this high dive before you have to jump off, and then, that splash is only going to be that much bigger. And I think that's one of the reasons why we all buy precious metals.
And you brought up before we started recording the stock market, and you were asking me if I think the stock market's going to crash. And I was like, well, maybe it crashes for a short amount of time, but the US government, with the tax receipts going into the US Treasury for capital gains taxes, they can't afford that. So back in like February of 2025, so like 6, 7 months ago, Trump and the people in his administration said they didn't care about the stock market. Well, guess what? Within like 6 weeks, under 2 months, he had done a 180 and he was pumping the stock market again, talking about it going up. But the stock market, Bob, in my opinion, is not rising due to a good economy. It's not rising due to good fundamentals in the U.S. economy. If anything, I would argue there's a lot of stagflation and inflationary pressures. The tariffs are hurting small business. There's a lot of evidence of recession with a lot of people not getting their jobs. But I think the main driver here of the stock market, it's a devalued dollar, and you can also see that in the metals prices.
Well, not only that, I mean, there was a post written about where the top, what, 7 or 8 S&P 500 companies, their capitalization is larger than China's entire GDP, annual GDP. I mean,
And the country of Canada too. Nvidia is now larger than the entire country of Canada.
I mean, it's just amazing. I mean, coming from the 1999 2000 crash, I've been in the business since '92, so I've seen a lot of these bubbles. But this is just epic. In terms of the amount of like the core weave situation, and the almost the structure of keeping this thing going and just expanding it and then running the shorts, and you see Oracle jumping 30% in one day. I mean, these are big companies that are moving almost like penny stocks.
Intel too, and the U.S. Federal government. What that was inside information on that deal. So the U.S. government got their 10% equity shares over a month ago, knowing that Nvidia was negotiating with the bailout for Intel. So that was inside information. I'm sure people here in DC were trading on the inside information with stock options, both political parties. The whole thing is just a mess at this point. But it's not fundamentals. It's turned into a rigged casino with
Right.
fiat currency.
Yes. Yeah. And that's, I think, again, that drives people to simplicity, and typically hard assets historically through time has been one that people gravitate to what they trust, and what they trust is what they go hold in their hand sometimes.
Well, now it's a math problem, Bob. I mean, like the budget deficits, the dollar, interest rates. I mean, we're just where there's no good options at this point. I mean, it's basically more or less rearranging deck chairs on the Titanic. So if Trump puts on the tariffs, he thought that what tax revenues, tax receipts would increase massively with the tariffs, but then that's hurt the real economy. It's hurt a lot of small business owners and consumers. So there's huge trade-offs there.
Yeah. Yeah, definitely.
Yeah, so I mean we're in what I call, stagflate tax lie mode here, where the government with the math problem here with the budget deficits and the lack of foreign demand for US treasuries, we finally gotten over the last 10, 15, 20 years to the point where there's no good options left, and it's like, well, is the Fed going to start fully monetizing debt and announce QE and balance sheet expansion? Are they going to go to yield curve control because yields are starting to go down? And the dollar is already, not looking good. The dollar's been very, very weak now for 2025, all of 2025, with the worst start in the worst year, I think, in decades.
Yeah. Yeah, and that's something that I think has taken a lot of people by surprise, because we always hear about Europe in such recessionary type situations, and yeah, the trade difficulties between them and Asia and so forth, and the energy situation. But yeah, it's come home to roost here in the United States.
Well, the US also had relatively high interest rates compared to a lot of these other countries because they hadn't started cutting interest rates. So normally in the past that would have been a strong dollar, but you have a situation with the budget deficits and then all the sanctions that the foreign governments and we were talking about for, the last 15 or 20 minutes, that they just decided that even though on a relative basis the US has relatively higher interest rates, and in the past that would have meant a dollar rally and people would have bought more treasury bonds, that has not happened because I think of the bad policies out of DC.
Yes, it's almost as if the higher interest rates are allowing people to take that term premium risk, and buy the treasuries. Otherwise, I think if interest rates were lower, I don't know if people would, you may see even less participation.
Well, the lower interest rates would help the mortgages for a lot of people because then they could refinance, and some businesses could refinance if the interest rates did go down. But you're in a situation when the Fed raised interest rates as quickly as they did, they actually blew up a lot of bond fund managers and the banks. So a lot of U.S. banks and foreign banks that were holding older U.S. Treasury bonds as they were raising interest rates to quote unquote fight inflation, they're actually blowing up the balance sheets of a lot of bond fund managers and banks that held a lot of like U.S. Treasury bonds.
Yeah, yeah, yeah. Well, what's interesting too, I mean, yeah, you do have interest rates, on the 10-year, they've been coming down a little bit. But you could get a situation where, the Fed cuts rates, and all of a sudden the longer end of the curve actually starts to rise again because of this worry of inflation.
Now, if Trump goes to more sanctions, do you think we're going to see even more announcements from like the BRICS and China and Russia and India that they're going to be rapidly accelerating some type of alternative to SWIFT? Do you think we're going to see that in the near future?
I think it's just natural. The BRICS. I know a lot of people make this sort of uh, comparison of the BRICS acting as a uniformed effort of countries that would be that could compete with U.S. and the G7. I think BRICS are more of a trade type of organization that are just saying, listen, we see the difficulties in the G7, and we're just trying to maintain and keep our economies growing, or from stagnating. And we're looking for trade policies that would actually fit well within our own uh, organization or network. I don't think they're trying to compete with G7. I think they're just trying to yeah, maintain some stability, and because a lot of the nations within the BRICS countries are having difficulties of their own.
Well, I think the BRICS was created by accident, right? Because initially, I think it was a marketing name that Goldman Sachs put on like emerging markets. They just called it the BRICS, and it was like a marketing thing that they were doing back in like 2007 or 2008. And the entities started to see that they didn't like the policies from both political parties, Congress, and the White House coming out of DC. Now you add in the sanctions, and the BRICS are just saying that the current dollar system that we have, the dollar standard with treasury bonds as collateral, the euro dollar system, they don't like a lot of that system here, especially if they're going to fund the U.S. Treasury market and the U.S. government's going to be, putting bad sanctions on or spending like crazy running. I had the budget deficits in 2024 at 3 trillion. So I know the Congressional Budget Office says that they were only 1.9. I do not think that that was a real number. I think it's way off. Just like how the jobs reports now are phony too, with all the
Yeah,
revision.
yeah, and I think you can make a good argument that the BRICS countries, just like uh, it's the Shanghai Accord, which is actually bigger than the BRICS in terms of GDP. Um, I think the the idea of reducing friction costs of transaction with currencies and so forth, I think also is a big appeals to these organizations where they don't have to actually trade with dollars and then they have to get out of the dollars into their local currencies again. They're just trading local currency to local currency and having building trust between countries.
As we wrap up here, I have one more question. Do you see any possible macro scenario or policies that would stop metals prices from going up? Either monetary policy by the Federal Reserve Bank or policies out of Congress or the White House preventing more inflation, preventing budget deficits, and preventing the dollar from either staying weak at these levels or getting weaker, and preventing gold prices from going to $4,000 or $5,000 an ounce in the next couple of years.
I think we're in the sweet spot with the metals currently as we kind of melt up, but I think at some point you're going to have this where the metals get up high enough in price where you know that high price tends to be a deterrent to maintain it. So it's going to be more costly to maintain gold at $5,000 an ounce. It just takes that much more money to do that. And then I think there's also this idea that you could have some political or economic fallout at some point. I mean, typically when gold goes to new all-time highs, usually something's going to hit the fan. So you could get some economic activity that creates a recession, or this idea that people then all like you said earlier in the podcast, where people are selling gold for liquidity to pay bills, turning that gold into currency again. You could see that happening, especially in a deleveraging event where all of a sudden a lot of gold programs have come up through the ranks. A lot of gold schemes have come up through the ranks where you have taking loans against metals, leasing metals, financing metals. All that type of stuff can actually start to work backwards if you start seeing an economic contraction, especially in asset prices. All of a sudden, you get people that are forced to sell because they have leverage tied to it. That could come in at some point, but I don't think we're near that yet.
Yeah, I mean, for the retail bullion investors, right now the demand increases. We've been talking about this over the last our last couple of interviews that you've been on here over the last 6 to 9 months. Costco's been one of the main drivers. A lot of the regular online retail bullion dealers have not been doing well. There's been profit margin problems. So despite the metals prices rising, but the main issue here now is I think a lot of people just don't have the discretionary income, the savings, the funds to go and buy a lot of the metal. So there is metal demand. I would argue it's coming from like hedge funds, pension funds, institutional investors, and for gold at least, it's the non-G7 central banks. For silver, I would say it's like foreign technology companies that are stockpiling it, for solar panels and other industrial end users, and maybe like some silver purchases in China for platinum, palladium, and silver. But really, the retail investor in the U.S. and Canada, they're not huge buyers of physical gold and silver coins and bars right now.
Yeah, and don't forget, I know this at sort of the social media. I think it was last year when Samsung came out with this idea with the solid state battery using silver, and the productive effects. Faster charging, longer lasting. You could be seeing maybe some of these fabricators or industrial users stockpiling silver now for anticipation of potentially a rollout of this type of technology. Maybe not this year, but potentially next year or the following year. So that,
Well, but Apple, the other seller is Apple, and Apple's not doing too well for a lot of new sales for their brand new phones because of the price point. So that just shows that the economy is not doing as well. I think I heard that a lot of the people who own iPhones, they're waiting like an extra 12, 18, 24 months now before they buy another phone, or they're buying a refurbished phone, or they're buying a new battery to swap out because they don't want to go pay, like way over $1,000, almost $2,000 for a brand new phone.
Yeah, and that upgrade feature, I just don't think you have as many upgraded features that attracts that audience. Like it may be the jump from 10 years ago, each year probably saw an accelerated amount of upgraded features versus today.
Well, please tell my listeners more about your work and your company, Idaho Armored Vaults.
Yeah, definitely. I have I'm on X, Profits Plus ID, where people can find me on X. We also have our website goldsilvervault.com. We post interviews there. We have one of the largest private depositories in the country, storing $1 billion of metals outside the financial system. In fact, I think we're the only depository that's not owned by a gold dealer, financial institution, or a cash in transit company. So we're not transactionally oriented in terms of revenue. So it's mainly more storage or storage fee based, which I think promotes a less conflict of interest for the customer. But we also, through my registered investment advisory company subsidiary, we can buy and sell metals. We offer some of the best prices in the country. Those prices can be found on goldsilvervault.com as well.